And throughout the presentation, if my audio gets screwed up, please everybody speak up, and I'm happy to repeat. You know, I can't hear how you're hearing me. I can just hear myself talk. So first off, thank you so much. I'm so excited to be talking to you this afternoon. So thank you for joining. And my hope is really that you come away from this better informed than you started on investing, and that you come away more confident regarding managing towards your particular financial goals. We really developed this to be a kind of a general presentation about investing, but as we go along, I will pause for questions. And as you can see by the many disclaimers that we have over here, I can't really speak to maybe your individual situation, and this is not designed to give specific advice. However, please do ask your question and I will answer it the best way that I can. So as here you can see, we do have a disclaimer here, and also on our next page that we are just intending to provide a basic overview of generally accepted principles of investing, and it is not intended to offer specific financial advice. Please consult your accountant or tax advisor. All right, that's all out of the way. So what are we going to be talking about today? Well, like I said, this is really sort of a generalist approach, because you say the word investing and it can cover a lot of topics. So what we're going to talk about is, what do we actually mean when we say investing, and why is it important? You know, you should know why you're doing what you're doing. To help you get started, I've listed a bunch of questions to kind of start the whole process and kick it off. The really meaty stuff, and this is really where my expertise lie in, is talking about the key concepts of understanding risk and return and the basics of asset allocation. Those are the two main things that investing is going to really be involved with. We'll finish up with some general best practices when investing. Some of them you may have heard before, some of them you may not, but think of them as sort of my tips to you and stuff that I've picked up along the way. And then finally, we've included a page to help you get started on next steps. So a little bit about me. This is what I look like when I can actually go get my hair colored. So it's been fun being at home during this quarantine. I'm Sharon Galla. I am a proud both volunteer and board member for Dress for Success. I'm delighted to be involved with this organization, and especially I was delighted to hear that they had wanted to do a presentation on investing, because that's what my background is in. I've spent 20 plus years in institutional portfolio management. I hold the CFA charter, that stands for Chartered Financial Analyst. It is a industry certification that involves passing 3 exams and having a specific experience within the industry. So I am very happy to share with you the knowledge that I have, and hope that it is helpful for you. So let's get started. So what do we actually mean when we say, what is investing? And in this sense, it's purchasing an item. In this case, it's going to be a financial asset with the expectation that that item is going to grow and either offer us some income or a profit. Another way of thinking about it is putting your money to work, or what I always tell my kids, it's important, have your money make money. Put that money to work. Don't just have it sitting in a bank account. However, you may have reason to have it sitting in a bank account, and we'll get to that. Why is it important to invest? you are going to have a better chance of achieving your financial goals if you take the time to sit down and think about a plan to invest. It has been proven time and again that people who take the time to sit down and even just think about a plan or putting together a rough plan have a better chance of moving forward on those goals than someone who doesn't do anything at all. As my father used to say, fail to plan, plan to fail. So just the act, and frankly, just the fact that you signed up for this webinar, I commend you, because this is the first step in moving toward achieving your financial goals. The other reason why it's important to invest is, frankly, we need to keep up with inflation. Prices go up over time, and your purchasing power can be affected if, if you're in a job, you're hoping every year that perhaps you're going to get just a cost of living raise to keep up with living expenses. For certain other financial goals, the prices of what you're saving for may keep going up. So investing is going to help you maintain your purchasing power. So this is one of my favorite topics, and this is something that you may be aware of, but it's a point I want to make. And this comes down to the, well, I only have maybe a little bit to save. And this is to get you comfortable with that. And that's the power of compounding interest. Here's just a very basic example is if you started with $100 and you assume that you could earn 3% a year, at the end of that year, you're going to have $103. Well, all right, you made $3. By the way, you didn't have to do anything. We're assuming this investment, we knew we were going to make $3. Well, now the next year, you're starting off with 103. And so that 3% is going to be off of that higher balance that we have now because we didn't have to do anything. At the end of year 2, now you have 106. Same application at the end of year 3, you now have $109. Okay, that doesn't seem very exciting, but now think about if we increase the amount of money we're talking about and we increase what the investment earns. Long time horizons and the power of compounding interest can help you achieve your financial goals. You just have to get started. So remember the power of compounding interest. It's there in your favor. So now let's talk about returns on asset classes, and this is a slide we're going to come back to because we're going to talk a little in a few minutes about risk and about diversification. What I've laid out here are common sectors that people invest in, stocks and bonds, and then some other asset classes you may not be as familiar with, international stocks. And here in the industry, we talk about developed countries such as Europe. And then there's other countries that we call emerging markets. I'm trying to think of a good example, like say Malaysia. So if you look at the long-term returns that you're seeing from these various asset classes, you can get a few observations. 1, they go up and down. 2, you can see for the year-to-date 2020, they're pretty kind of extreme. You see stocks going down, bonds going up, international going down a great deal. But if you look at the longer-term returns, this generally helps you understand the type of returns you might see by investing in these asset classes. Again, past performance is not an indicator of future results, but I think it's important to start somewhere to get somewhat of an idea of what could you earn by investing in these various asset classes. And also when we're going to talk about diversification and risk, you'll see that when you're building an investment portfolio, it's important to think about diversification. So I want to pause here. Any questions so far? Okay. Again, feel free, and remember, you may be on mute, so if you do want to ask a question, remember to hit that button. That's something I do all the time. All right. Questions to ask before you get started. And the first two bullets on here are sort of related, and I'll tell you a little story. Because I work in the financial markets, I always have relatives and friends who ask me questions. And I remember at one point early on in my career, a cousin of mine said, "Hey Sharon, should I be buying the stock market here?" And what I had to tell him was, that's the wrong question to be asking me. First, we have to go actually more than a couple steps back and see, do you even have money to invest? And how much? Do you have a debt that needs to be paid down? Do you have an emergency savings account? So those are some of the things you need to ask yourself as you're starting out. Do I have extra money to invest? How much do I have? We're going to talk about emergency savings in a minute. That's going to be the next slide. But you should also look at your current financial situation. You may have debt that this extra money that you have would be better served paying down that debt than starting to save toward another financial goal. So that's something to think about. In general, one of the things we think about in finance is that if the rate that you are paying on that debt is more than you think you can get that money to earn, you probably should pay down that debt. So this goes for things like credit card debt, student loan debt. Again, depends on your personal financial situation, but that is something to consider. So let's assume that we've answered all this. Then you need to think about, what is the goal I'm trying to achieve, and what is the time frame for this goal, because this is going to affect the asset allocation, the appropriate investments for you to consider, as well as how do I feel about risk. And I think everybody maybe thinks that they know how they feel about risk until you see volatility in the market. And again, I'll share some personal stories with you about that. Finally, you want to ask yourself, do I want to do this by myself, or do I want to get some help? It kind of depends. Some things that I think most people can handle themselves with a little bit of education. There's certainly nothing wrong with getting someone to help you, and we'll talk about that as we go through resources, what's out there. So emergency savings. So remember I said before you're even going to be thinking about investing, you need to think about emergency savings. Certainly the current situation with so many people being affected by this economic environment, being laid off, being furloughed. This is why emergency savings, when we talk about investing in general, especially personal investing, it's really important that you have this covered first. So if you're thinking of kind of the triage of your personal financial management, emergency savings is the first step. General recommendations are to have at least 3 to 6 months of living expenses saved. You may even want to be more conservative and save more. It should be in a very safe, low risk asset. And that generally means with a bank, credit union, in a savings account or money market account. You always want to look for somebody who has FDIC insurance. Here, the tip I just want to make sure you understand is understand any fees that your bank is charging, because I'm going to touch on this later. Fees are your enemy. They eat into your returns, and there are differences between different financial institutions. So understand what those fees are. You may see a really great rate out there, but it may also come with a higher fee. So educate yourself on that. So once you get this achieved, then we can start talking about investing for other goals. So now we need to understand about risk and return. One of the things about risk is when you actually look at the definition in financial terms, risk is actually the chance that the investment's actual return is going to differ from the expected return. So it doesn't mean that it's just going to lose money. It also could be that you can get a higher return than expected. Risk means volatility. So the classic financial chart you will see out there is that assets with a higher risk will offer more potential return, but they will also offer a lot more volatility. Depending on what your financial goal is, that's going to help determine what your risk tolerance is, which will also then determine what assets may be appropriate for you to invest in. However, you also have to think about your own personality and your own personal situation. Could you afford to take a loss on the investment? Are you going to be up at night worrying about your investments during times of market volatility? Be honest with yourself, because you know what? It might be that if you don't want to take a lot of risk, all right, it may take you longer to achieve a financial goal. You may have to save more because you're not growing your investment as great as possibly you could. But you know what? If you can sleep at night, that's worth something. So be honest with yourself. And so again, these are things you want to think about. A little bit of a primer on what drives returns. When you think about stocks and bonds, and you hear different headlines during the day, the stock market is up, interest rates are down. These are some of the things to be aware of what could possibly be driving those movements in the markets. So how are stocks valued? Well, the stock market reflects expectations of future corporate earnings. And this can be driven by current economic conditions, thoughts about how profitable corporations are going to be going forward, any changes to the tax code, and geopolitical events, such as what's been current in the market are the United States trade policies versus China. Obviously, we do a lot of trade with China, and anything affecting that can affect corporate profits. So you'll see that particular subject come up a lot. For bonds are valued the way we do in the business is there's a risk spread and a risk-free rate. If you're just buying U.S. government bonds, then essentially you're buying the risk-free rate. If you want bonds that are such as a corporate bond, then what you're earning there is a risk-free rate plus a risk spread. How risky do we think this corporation is? Do we think that they are going to pay us, the bond holder, back? A bond is essentially a loan. I'm going to lend you money, you're going to pay me interest, and then you're going to pay me my principal at the end of the term. Bonds are valued by looking at where interest rates are, also the Federal Reserve policy, whether the Federal Reserve is holding short-term rates low or whether they are raising them. Again, U.S. economic conditions and inflation expectations. All of those will affect where bonds are trading. Little quick guide, as interest rates go up, bond prices will go down. As interest rates go down, bond prices will go up. You can lose money by buying bonds. Sometimes people think, oh, a bond is very safe. It depends on the bond. So understand that if you are going to look at investing in bonds, understand what you are buying and how they are valued. I'm going to pause here. Does anyone have any questions so far? Okay, great, thank you. So we talked about asset allocation. Depending on what your goal is and what you're investing for, that's going to help determine the mix of assets that you should be looking to invest in. The mix of the assets are going to reflect the time horizon, when the funds are needed. Also, again, we talked about your risk tolerance. So all of those are going to affect the asset allocation. The majority of your success in investing is going to come from doing the correct asset allocation. So what I've laid out here is just, again, some different types of goals for investing in a possible allocation. The first one, a college savings fund for a 10-year-old. Well, their first year of college will start in 8 years. So we have a generally long time horizon. So it could be very appropriate to own a larger percentage in stocks, maybe a little bit in bonds just for some diversification. The general rule is, it's sort of a rule of thumb. Stocks are appropriate for an investment period of 10 years or more. Anything inside of it, you might want to consider putting in some bonds or cash. The next one is a retirement savings for a 27-year-old. Well, here we have a very long-term horizon. And here's another one where I'm going to call back to the power of compound interest. The earlier you start saving, the more you can benefit from that. Time is your friend. So here, you very well could easily make an argument for 100% in stocks. Again, you might want to diversify it. That's okay, but you know, this would be a you could argue for that allocation.
I'll go out with you. I'll go out with you after this is over.
Oh, we have somebody. If everybody could mute their Zooms, please. We're getting a little background noise. Thank you. And then finally, a home purchase in 3 to 5 years. Now here, you'll see there's no stock allocation. This was actually my allocation for when we were saving many years ago to buy our house. We had a 3 to 5 year time horizon. And what I did was most of that money went into cash, but I ended up buying individual government bonds that matured in 3 years. Back then, you could earn a 5% coupon on a government bond. Things have changed a lot since we bought this house almost 20 years ago. Interest rates now, I believe, are about 0.33% on a 5-year government bond. So very different world. However, we didn't want to take a risk on this down payment. So we wanted to make sure that the principal was going to get paid. So we picked very safe investments for that home purchase. So again, these are just examples, but it's to show you that you're going to have a different mix of investments depending on your goal. So coming back to the idea of diversification, when you're investing, depending again on the goal, you can think about diversification as both within an asset class and among asset classes. What do I mean by that? Well, we always talk about stocks, bonds, cash. Those are the traditional asset classes. So you may say, well, I want to be diversified. Diversification helps you weather the ups and downs of the market. In general, when stocks go up, that means the economy is doing very well, and bonds tend to have higher rates and lower prices. So if you want to be diversified, you put those two asset classes together, and you should earn then over time a balanced rate of return. You won't have as much volatility in your returns. However, if you have a stock, just a stock portfolio, you'd want to be diversified within that. What do I mean by that? You could just go out and buy Amazon. Well, now all of your money is tied up and is dependent on how Amazon does. In general, the recommendation is you want a diversified portfolio, and you can do that by buying a mix of various types of stocks: large cap, mid cap, small cap, meaning larger, companies with a larger presence in the market, smaller and middle. International and emerging markets, a little bit more riskier on the spectrum of what you can invest in stocks. And the same goes for bonds. There are different types of bonds, some that are riskier, some that are safer. There's a mix that you can pick and choose from. In general, the idea with diversification is that you can achieve a rate of return at a lower risk profile by diversifying your investments. Any thoughts here or questions?
Yes, Sharon. Someone had a question. They put it on the chat. Hopefully I'm not breaking off, but Ellen wants to know, she doesn't understand bonds and how they differ from stock. Would you please explain it again?
Oh yes, and that's a great question. Okay, let me think about the best way. Okay, the Gala Corporation. The Gala Corporation wants to grow their business. I am going to sell stock shares. When you buy a stock, you're buying a share in the profitability of a corporation. And the company is going to take the money and hopefully grow their business. So now you are part owner in this company. You will earn a certain percent of the outstanding shares of that company in stock. What you hope is that this company is going to continue to grow and that they're going to earn more money over time. Therefore, the value, the price of this stock is going to go up. So if you bought the stock at $60, you're hoping over time that this company is going to continue to grow and expand and gain more market share and be profitable. And maybe you think that stock in time can grow to $80. The other stocks pay what is called a dividend. A dividend, think of it as it's an extra payment. You're benefiting from owning part of this company, and if they turn a profit every year, you're a part owner, you're going to earn a little bit of income from that. So a stock that pays a very high dividend, in general, they don't go up in price as much, but the idea is that they are a steady earner, and so then you benefit from the dividend payments. So again, a stock represents ownership in a company. The stock price is going to go up and down depending on how the stock market views this company's prospects within its industry, within general economic conditions. Some stocks can be within sectors that are very risky. Some are more, what I would say, tried and true and kind of boring. But that in general is how I think about stocks. Bonds are a loan. I'm a corporation. I want to go invest in some equipment. And let's say I don't want to issue stock. I want to raise money through the debt market. Maybe, like right now, it's very cheap to borrow. And if I'm a strong company, I'd rather borrow from the market because it's not costing me a lot. So a bond is a loan. A person buys that loan and the bond will pay a coupon. That coupon reflects the risk, also the tenor of the bond. So you can have a 1-year bond, a 3-year bond, a 5-year bond, a 10-year bond, even a 30-year bond, where the corporation will pay you a coupon, and at the end of the loan will pay you back what we call your par amount. So I'll give you an example. Let's say the Gallo Corporation is selling you a bond at what we call par, $100. You're going to pay $100 and I'm going to give you a bond. And I'm going to pay you 3% interest on that bond for 3 years. And at the end of that, I'm going to give you the $100 back. So you've earned that 3% over time. The risk with bonds is that I mentioned the US government bonds, where you're borrowing from the US government. That's the safest bonds that are out there. You're not worried about getting your principal back. The problem is you're going to earn an extremely low rate of interest on those bonds, so you're not going to earn a lot. Also, you've tied your money up in it. A corporate bond is going to pay a lot more in interest. However, the risk there is, suppose the corporation goes under. Well, there's a whole other discussion about, are you going to get your money back? So there's risk with that. So in general, a bond is a loan. If you hold the bond to maturity, you don't have to worry about the bond price. If you sell the bond prior to its maturity, the price of the bond will depend on the current interest rate in the market versus when you bought it. And I'm getting a little technical here, but just know if you sell a bond before it matures, you could have a gain or a loss on the price. I hope that helps. Do you need me to clarify any of that? Because it's an important point, and I recognize it can get confusing. So let me pause here and see if that worked.
This is Ellen. I was wondering, I was one that asked the original question. Can you explain par? Is that the purchase price?
Yeah, and I'm sorry, par is actually, it's the amount of, it's funny, it's a technical term. Par can mean 100. It can also represent the amount that you buy. So if I buy a bond in institutional terms, we'll say, well, how much par are you buying? I'm going to buy 5 million par, and I'm going to buy it at $100. When if I say $100, that means par. You could also buy 5 million par at $90. So par can refer to both the amount that you're buying in the bond, think of it like stock shares, but it also can refer to the price of the bond. If I buy a bond at par, it means the price is $100. If I buy the bond at a discount, the price would be anything below 100. If I buy the bond at a premium, it means the purchase price is above $100. Why would I buy a bond at a premium? Bonds at a premium will pay a coupon higher than what current interest rates are offering. Bonds are confusing. This is, and that's where my specialty is in fixed income. That's why for most investors, again, depending on what you're investing in, if you are looking at bonds, it's important to understand how they operate and how they work, because they are different than stocks. Does that help, Ellen?
Yep. And the last thing you said is if you hold the bond to maturity, then what doesn't matter?
You don't have to worry about taking a loss on price.
Okay.
If you sell a bond, if I own a 3-year bond and I bought that bond at a 3% interest rate, and let's say I bought it at $100 at par. Let's say you want to sell that bond before it matures. So we're 2 years into that bond and you want to sell it before maturity. Let's say now that interest rates are at 4%. The price of your bond in the market will now be lower because someone now has to buy a bond paying 3% where the current market's offering you 4%. Therefore, the price that you paid, that $100, that's not what you're going to get back. I'm making this up. We'll say you're going to get $90 back. So you took a loss on your price. But if you wait until the bond matures, you will get paid back at par. A bond will always get paid back at par, except if it's in default, but that's a whole other discussion. But under normal circumstances, so if you're buying an individual bond or a bond fund, that's important to know that you can have gain or loss on your price.
Okay, thank you.
Oh, you're very welcome. And again, I appreciate that because being in the fixed income market, bonds are confusing. They have their own nuances, and frankly, we could do a whole other presentation on them. So that was a great question. Few words about our friend taxes. Again, we had the disclaimer here. I am not an accountant. This is more to make sure that you're informed and you're thinking about taxes as you invest. Where do taxes come in? Well, gains and losses on your investments could possibly be taxed. We talked about coupon income from bonds and dividend payments from stocks. You can get taxed on those. However, there are vehicles to invest in that can maybe help lower that tax bill on your investments. These vehicles depend on what you are investing for. 529B funds have to do with saving for college. These are various plans that allow you, think of it as a 401k for college savings. You put the money in and the money grows tax-free. You have to pay taxes when you withdraw the funds, but they get to grow tax-free. That's the same with a 401k plan. If you're lucky enough to have your employer offer these, you get to deduct your contributions and they will grow tax-free. Same with an individual retirement account. There are two types, a traditional and a Roth. Both are treated differently. With the Roth, the idea is that you pay taxes today, but when you take the money out later after you retired, you don't pay taxes. With the traditional IRA, your money grows tax-free, but you do get taxed when you take the money out. However, your contributions are not taxed in the current period. So this is where it helps to understand your current tax situation and be aware that there are ways that you can address taxes. It just depends on the vehicle. So how can you get started? What I've listed here are various forms. It kind of depends on your personal situation. If you are saving for retirement, again, if your company offers a 401k, and even better, if your company offers a 401k and they will give you matched funds, that is free money. And you really, if you can, try to meet the minimum requirement needed to save to get that matching fund. Again, it's free money. It's a great benefit. So you can invest through your work 401k. They will offer various types of investment vehicles. You need to take a look at them and again, decide on your asset allocation. You can also open up your own personal IRA. A lot of times that's done with through an investment firm, such as Vanguard or Wellington. If you are in just, I would say generally investing, not in a specific vehicle, but just trying to put money to work, you can do that through an investment firm, through buying mutual funds or ETFs, exchange traded funds, or you can open up a brokerage account. 529B plans are an excellent way to save through college. You can sometimes get you can get a tax break if you are saving within the state you live in, within their plan. However, you don't have to. Personally, I live in New Jersey, and my children are invested in the Utah fund plan because they have low fees. And finally, you want to take a look at your bank or credit union. Take the time to shop around. Credit unions can offer very attractive rates on money market savings accounts, or in general savings accounts. Again, I'm going to come back to fees. Really take a look at the fees because they will eat into your returns. A few words about today's investing environment. Goes without saying, I think everyone's aware that the economic effects of COVID-19 have had a dramatic impact on the global financial markets. This is the news every night. Where we're going forward here is that US interest rates are most likely going to remain low to support the economy going forward. That does hurt people who just want to save money within bank accounts. Equity markets currently are very optimistic regarding a recovery. Since March, where we had a very large drop in the stock market, where the country really understood what the impact and the whole lockdown in March took effect. We've retraced back from there, but there is still a great deal of uncertainty regarding how we're going to come out of this downturn. So expect financial markets to be volatile for some time. And this again is going to come back to your own particular risk tolerance. There is going to be volatility in this market. Other things that could be affecting bond and stock markets, the upcoming presidential election, continuing geopolitical issues, the long-term impact of the COVID-19 effect on the economy, and how the federal bank is going to be adjusting interest rates going forward. So all of those out there, you need to be aware that it's going to be volatile for a little while going forward. So take a deep breath, stick to your asset allocation plan. That really is, as we go into selected best practices, the best advice I can give people is understand what you're saving for. Once you know what your general asset allocation should be, stick to it. That's going to help keep you from making bad decisions and maybe getting out before you should. Just because the markets are volatile should not keep you from starting your investment plan. So a couple of tips here. Diversification, we talked about this. It helps lowers the risk in the portfolio of assets. Don't check your investments every day when there's volatility in the market. Don't panic. Because, and this is an important part, you don't have a real loss until you actually sell and put in an order. Until then, it's only on paper. I will share with you that I knew some of my relatives during the great financial crisis of 2008. They were invested in stocks. There was a huge retracement there. They panicked and they sold. And the sad part is, if they had, kind of weathered the storm and held on, they wouldn't have had to take in those losses. Over time, the market came back. So again, think about your asset allocation and what your time horizon is. So if you have losses, remember, they're not real until you actually sell them. Don't try to time the market. So we talked about all this volatility coming in, and you may go, well, the stock market is at such high levels now, I don't know that I want to, invest in it. Dollar cost averaging is really the best approach. And what that is, it means over the course of, say a year, whatever time frame that you're looking to invest in, you invest a little bit each month or each week. It depends on how you want to approach it. But the idea is that you're not trying to call the bottom, you're not trying to call the top. You're investing in over time. That way you're averaging out. So you're not going to feel bad that you didn't hit the low, and you're not going to feel bad that you paid too much. I will, raise my hand and go, I say this all the time. Do I always do it? Do I try to time the market? Yeah, sometimes I do. And most of the time, research will tell you trying to time the market, it doesn't pay off over time. You're really better off dollar cost averaging. Again, stocks are appropriate for long-term investing. So I would not recommend putting stocks in unless you have that longer-term horizon. Set up automatic investing to help keep you on track. I find that for keeping people sticking to their plan, as long as you know that you can deal with having however amount taken out, whether it's for your 401k or for your own personal savings plan, it really does help to have it set up so you don't have to think about it. You're more likely to stay on goal if you set up automatic investing. Very important. Do not invest in anything you don't understand. People will try and sell you financial products and talk a good game and tell you that everybody's doing it. And if you can't explain this investment to your best friend or your mother, don't buy it. I can't emphasize that enough. You really want to make sure that you understand fees, you understand the risk of what you're getting into. So don't feel bad about not putting money to work in something unless you understand it. And again, I mentioned about fees. Understand your fees, especially when it comes to various mutual funds or really any type of investment. Different fees, different companies charge different fees, and they will eat into your return. And in general, index funds that essentially mirror the market are going to generate better returns with lower fees than what we call active management, which is somebody trading something to try and do better than the market. Index funds, such as you can buy an S&P 500 fund that will track the general return of the S&P 500, which is made up of 500 companies in the market. Someone who's an active manager is trying to make decisions in and out of that market to try and generate a higher return. Over the long term, research has found, though, that index funds are generally the better way to go. Well, we're coming up on the end of the hour. I want to pause here and see if there's any other questions.
There was a question from Ellen. She was asking if you could please explain ETF.
Sure. An exchange traded fund. This is a new financial instrument that hit the market. An ETF is very similar to a mutual fund in that you can buy a diversified grouping of either stocks or bonds. The advantage with an ETF is that generally there are lower fees. You don't have to, your pricing is going to be, it's like trading stocks is the best way I can describe this. With a mutual fund, the price is set at the end of the day. The mutual fund has to go out and buy all of these shares of all these various companies, and they have to wait till the end of the day to price it. Within an ETF, you can go in and out of it just like a stock. I hope that helps. It's ETFs offer, I also believe there's some tax advantages to an ETF of the way that they're treated versus a mutual fund. but that's something I would recommend as I jump forward to additional resources. You can find a little bit more detail at one of these on one of these websites. I will tell you that I'm a big fan of Bankrate.com. They do a really great job of showing you options out there for a lot of different financial instruments. Also, Kiplinger.com is another great website. Finally, I'll tell you that personally, you'll see a lot of different financial gurus out there, as it were. I think it's always important to understand, again, do they have any type of agenda? Is there a product that they're selling? In general, I have to tell you, I'm a fan of Dave Ramsey. I think Dave Ramsey offers a lot of good, solid advice out there. But that's just my own personal opinion. So, take it for what you will. Or Amy, anything, any other questions?
No, but I also want to mention that we are sharing the slides, right, Sharon? We're okay to share it?
Yes, absolutely.
So everyone's going to receive them, and you'll be able to go over everything Sharon has discussed. Just wanted to throw that in there.
Wonderful. And again, I hope today was helpful for you. We'd love to get your feedback. If there are specific topics that you'd like to hear about, again, I really tried to take a very general top-down approach here and hit on general principles of investing. But if there is something specific you would like us to cover in another webinar, we'd love your feedback. We're here for you. So I hope that today was beneficial for you, and I really enjoyed being offered the opportunity to talk about this topic with you. So thank you so much for your time.
Yes, thank you so much, Sharon. Thank you, everyone, for joining us today. Computer's kind of off, that's why.
Thank you.
Thank you.
Thank you.
Have a good day, everyone.
Have a
Take
good
care.
weekend.
Bye-bye.
Good
Thanks,
weekend,
you
yes.
too.
Okay,
Good weekend.
bye-bye.
Bye-bye.